Welcome back, finance enthusiasts. The SIE, or Securities Industry Essential Exam, is an excellent way to begin your career in the financial investment sector. It encompasses the industry's fundamentals and prepares you for more advanced examinations. Now, let us continue preparing you to pass the Securities Industry Essentials exam with a discussion of the various fees and charges to expect when trading mutual fund shares. This is a follow-up from our previous mutual funds video, and we will end this segment with closed-end funds and UITs, or unit investment trusts, fees and charges. Before purchasing mutual fund shares, investors must review the total cost of fund ownership since, in addition to sales loads, funds assess annual fees based on the NAV of their holdings, including 12b-1 fees, service fees, and administrative fees. 12b-1 charges, also known as distribution fees. In a 12b-1 arrangement, mutual funds may pay for distribution expenses through deductions from the portfolio's assets. These 12b-1 charges are used to pay the costs of distributing the fund's shares to the public and cover expenses such as sales concessions and the costs associated with advertising and the printing of the prospectus. The 12b-1 fee is an ongoing asset-based charge deducted from the customer's account on a quarterly basis. Typically, 12b-1 fees range between 0.25% and 1%, but the maximum 12b-1 fee is annualized at 1% of the fund's assets. Service fees. Service fees are charges deducted under a 12b-1 plan and are used to pay for personal services or the maintenance of shareholder accounts. Trailing commissions or trailers are an example of a service fee. These ongoing trailer fees are paid to RRs as compensation for continuing to service their clients' accounts. Administrative charges. Administrative charges are deducted from the net assets of an investment company and are used to pay various costs, including payments made to custodian banks and/or transfer agents. Fee disclosure. At the front of its prospectus, a mutual fund is required to disclose all of its fees using a standardized table. Expense ratio. The expense ratio is defined as the percentage of a fund's assets used to pay operating costs and is calculated by dividing the fund's total expenses by the average net assets in the portfolio. The expense ratio includes the management fee, administrative fees, and 12b-1 fees, but does not include sales charges. Take note, total expenses divided by average net assets is the expense ratio. Expense ratios typically range from 0.2% to 2% of a fund's average net assets and must be disclosed in the fund's prospectus. The expense ratio varies based on the type of fund and the share class selected by the investor. No-load funds typically have lower expense ratios since their 12b-1 fees are limited to 25 basis points per year. Today, most funds offer investors the choice of multiple classes of shares, usually referred to as Class A, Class B, Class C, etc. The differences in classes are how the sales charges and distribution charges are assessed. Investors may choose between shares with front-end loads and varying 12b-1 fees, back-end loads with higher 12b-1 fees, or some other combination. Although the specifics of the different classes that each fund offers may vary widely, most funds provide the following classes of shares. Class A shares usually have front-end loads, but small or non-existent 12b-1 fees. Additionally, investors who purchase large amounts of shares within the same fund family may be able to take advantage of reduced sales charges through breakpoints or rights of accumulation, both of which are described below. The disadvantage of Class A shares is that not all of the investor's money is directed into the portfolio. For instance, if an investor purchases $1,000 worth of Class A shares of a common stock fund that has a 5% sales charge, only $950 is invested in the fund. The $50 is deducted as a sales charge and benefits the selling brokers. This class of shares is most suitable for long-term investors. Although the front-end load may seem high, the continuous internal expenses of Class A shares tend to be lower than those for Class B or C shares. Class B shares generally have no upfront sales charges, but higher 12b-1 fees are usually assessed. Investors are subject to contingent deferred sales charges if the shares are redeemed before a certain period. These shares are most suitable for investors who intend to redeem their shares within 5 to 7 years, especially if the back-end load decreases every year. Once the specified number of years has passed and the back-end charge is reduced to zero, most Class B shares will convert to Class A shares. Unlike Class A shares, Class B shares don't qualify for breakpoint or sales charge discounts. Class C shares incur what's referred to as a level load, which means there's an ongoing fee, typically 1%, for as long as the investor holds the shares. As a result, this increases the fund's expenses and diminishes returns, similar to the 12B1 fee associated with Class B shares. These shares are most suitable for investors who will hold them for a short period, more than 1 year, but less than 3 years. Although there's no front-end load, a back-end load may be assessed if shares are redeemed within 1 year. Many fund families also offer additional classes of shares for employees of broker-dealers, institutional investors, retirement plans, or other special categories of investors. In its prospectus, a fund provider must fully disclose each of the share classes it offers, along with the different sales charges and applicable 12B1 fees. Investors who purchase Class A shares have various methods to reduce their sales charges. Typically, these reduced sales charges apply to all purchases made within a fund family. Fund families. The term fund families or fund complexes refers to a single investment company or mutual fund company that provides many different types of mutual funds for customers to purchase. A fund family essentially serves as a brand name that encompasses several related individual mutual funds. A customer may be able to invest a large sum of money with one fund family, receive a sales breakpoint, reduce sales charge, diversify their assets, and switch between mutual funds. Breakpoints. Mutual fund shares must be quoted at the maximum sales charge percentage that the fund charges. However, most mutual funds offer sales breakpoints on shares purchased with a front-end load. Breakpoints are dollar levels at which the sales charge is reduced, the mutual fund industry's version of a volume discount. A fund's breakpoints must be clearly stated in its prospectus. For example, a person who invests between $100,000 and $250,000 will pay a reduced percentage sales charge or load of 3.25%. Letter of Intent, LOI. A letter of intent qualifies an investor for a discount available through breakpoints without initially depositing the entire required amount. The letter indicates the investor's intention to deposit the required funds over the next 13 months. The LOI may be backdated for 90 days to include prior purchases. Since letters of intent are non-binding, an investor will not be penalized for failing to make the additional purchases. However, this failure will result in a price adjustment that equals the higher sales charge that would have applied to the original purchase. Essentially, if a person fails to invest the amount stated in the LOI, the fund will retroactively collect the higher fee. Rights of accumulation, ROAs. Rights of accumulation enable investors to receive cumulative quantity discounts when purchasing mutual fund shares. The reduced sales charge is based on the total investment made within a family of funds, fund complex, as long as the shares are purchased in the same class. Rather than using the original purchase price, the current market value of the investment plus any additional investments is used to determine the applicable sales charge. Availability of breakpoints and rights of accumulation. Breakpoints, letters of intent, and rights of accumulation may be available to any of the following: an individual purchaser, a purchaser's immediate family members, that is, spouse and dependent children, a fiduciary for a single fiduciary account, a trustee for a single trust account, pension and profit-sharing plans that qualify under the Internal Revenue Code guidelines. Other groups, such as investment clubs, provided they were not formed solely for the purpose of obtaining reduced sales charges. Please note, letters of intent. Investors receive the benefit of a breakpoint without immediately depositing all required funds. And rights of accumulation. Investors can sum all purchases made within the same fund complex. Once a breakpoint is reached, all future purchases qualify for the reduced sales charge. Before a client purchases mutual fund shares, a registered representative, RR, must inquire whether the client owns other mutual funds within the same fund family in a related account, even if the account is held by another broker-dealer. To assess the maximum allowable sales charge of 8.5%, a fund must offer investors both breakpoints and rights of accumulation. This concludes the examination of mutual funds and related packaged products that are subject to the Investment Company Act of 1940. The next segment will describe some additional forms of bundled investments. As we conclude this segment, we invite you to show your support by liking this video and subscribing to our channel. It is a simple click for you, but significant support for us. And it is entirely free. Please turn on your notifications to be among the first to be introduced to variable annuities, municipal fund securities, such as local government investment pools, LGIPs, Section 529 educational plans, and 529 ABLE plans to excel in the SIE exam. Thanks.